Welcome! In this video, I will talk about estimation of loan losses and stress testing, especially in the face of COVID-19 pandemic. I will first talk about why we measure expected losses, and then how to calculate it, and finally, stress testing. Why measure expected losses? Well, it helps determine loan loss reserves, which is what lenders set aside to offset future losses on outstanding loans. And it's an important part of financial institutions' ability to sustain losses. Loan loss reserves appear in two places, the balance sheet and the income statement. Outstanding loans are recorded on the asset side of a bank's balance sheet. The loan loss reserves account is a contra asset account, which reduces the loans. Periodically, loan loss reserves account is increased with new expected losses, and this amount is recorded as an expense item on the bank's income statement. It is called provision for loan losses. This indirectly reduces retained earnings on the balance sheet, which in effect reduces net worth. Financial institutions need to make sure there is sufficient net worth cushion to absorb expected losses as reflected in the loan loss reserve. And also unexpected losses, which is losses that can be incurred if there was an unexpected event, such as the pandemic we're living right now. In order to account for unexpected losses, stress testing is used, which I will describe in detail towards the end of this video. Now let's talk about how to calculate expected losses. Expected losses are calculated by multiplying probability of default and loss severity. Risk rating and collateral valuation are important components of this calculation. Probability of default is calculated as the cumulative historical default rates per rating called current incidence. For example, incidence for 3 rated loans is calculated by the percent default rate of all loans that were ever rated 3. As you see in the graph example, the default likelihood increases with a decline in grade. Loss severity is the difference between loan balance and the discounted value of the collateral. And if there is a guarantee, then we take out the guaranteed percent from the loss figure calculated. And if ultimately the loss severity is positive, then the formula is what I just described, which is UPB, the unpaid principal balance, minus discounted collateral, and all of that times 1 minus the guaranteed percent. If it's a negative number, meaning that there is no loss after this calculation, then typically finance institutions apply a certain percentage to unpaid principal balance to account for loss. Going back to the collateral value, the reason why we're discounting the market value is that when a finance institution liquidates collateral, it's a distress sale. And because the sale needs to be fast, the collateral is often sold at a price lower than market value. In addition to that, there is additional cost of maintaining the asset and legal fees, etc. that reduces further what would be gained from the sale. Loss severity is a dynamic calculation just like risk rating and probability of default. As the loan ages, the unpaid principal balance declines, and the collateral value or the discount rate on the collateral value might change over time. Therefore, it is calculated periodically. Now let's talk about stress testing. As I mentioned before, stress testing can help us assess whether there is sufficient capital or net worth to absorb losses if unexpected events such as economic crisis happen in the future. It is especially important in COVID-19 environment to do stress testing of expected losses to see if your organization has sufficient capital to absorb losses in the worst case scenario. We already talked about how risk rating and collateral valuation help us estimate loan losses based on what we know today about the risk of loans and the overall portfolio. Stress testing helps us estimate losses that could go beyond expected levels due to adverse events that could happen. In order to do stress testing, we need to think about what affects risk rating and collateral values. For example, if interest rates go up, it affects capacity to pay for variable rate loans. You can recalculate debt service coverage ratio based on higher payments and see the effects of this on risk ratings, which would affect, in turn, probability of default and ultimately expected loss. On the collateral side, NOI, occupancy rates, and cap rates are main drivers of value. Again, as an example, if unemployment rates increase, occupancy rates could go down, which would drive down the value of the collateral and increase loss severity. COVID-19 has unique effects on expected losses. There is a lot of uncertainty about how long the pandemic will last and how deep the economic crisis will be. The effect of the pandemic differs based on the industry and the geography the borrower business operates in, and how much stimulus they can get. Here's an example of how you can incorporate industry and geography into stress testing. You create a grid by dividing each of these variables into 3 risk categories of low, moderate, and high risk. For geography, you can use states or local areas depending on your portfolio. In terms of criteria, you can use openness, unemployment rate, and daily new cases to determine the risk categories. On the screen, you will see some online sources that track this data real time. The industry risk categories could be based on your portfolio experience in regards to the pandemic, or you can use or supplement yours with external data. Then you create a combined risk categories and color code them, as in the example. For each color, you would use a different incidence level per rating. You can create 3 versions of this grid as a base case, best case scenario, and worst case scenario, depending on different economic scenarios. Here is another example of stress testing due to COVID-19 impact. So the question is, how would the expected losses for charter school portfolio change if there was a 10%, 20%, or 30% budget cut in future school years? First, you would need to look at what would happen to net cash flow with these budget cuts. And depending on whether it creates a deficit or still a surplus, then you would look at the effect on debt service coverage ratio or the amount of cash the school has. These would then affect the risk rating, then probability of default, and ultimately expected loss. This concludes the video for expected losses and stress testing. Hope you enjoyed it.